Palantir last quarter had a 34.77% free cash flow margin. That's freaking crazy. That is such a high margin. And back in Q1 2021, they achieved a 34.06 free cash flow margin, not adjusted. This is a pure free cash flow margin. If they can maintain 33% and above and continue to grow, these multiples are not crazy by any means. You start looking out going forward. This is a company with no debt. They don't have to worry about debt repayments. They don't have to worry about cash going there. They have options. They can do a lot of things.
Can you explain what the free cash flow margin is for those that don't know? I didn't know this a year ago either. So can you explain it for people?
Yes. So everybody who follows Palantir knows that they just became GAAP profitable 2 quarters ago. This is going to be the 3rd quarter that they're GAAP profitable. GAAP profitable is your net income, where it's your operating income minus all of your tax, however they do their tax GAAP accounting. I like free cash flow because it's a simpler number to look at. It is harder to manipulate because companies can massage net income with certain accounting metrics and how they allocate things. Free cash flow can't really be distorted. It's simple: cash from operations minus all your CapEx. So I like that number because that's where you make acquisitions from, you pay dividends from, you buy back shares from, and you, dividends, buybacks, acquisitions, pay down debt. I mean, that's what that pool of money does.
It's the actual cash register, right?
Right. So when you have a 34.77% free cash flow margin, every dollar that you're bringing in, that's your margin. That's how much free cash flow out of your dollar of revenue you're keeping. So you keep growing revenue, and look, their revenue growth, I want to see explode, because if you go back to that 2020 presentation or Q1 2021 presentation, it was very close after they went public.
Yeah.
They had predicted $4 billion in annualized revenue in 2025. Now, we're nowhere near there. I want to see that really ramp up. And if that can ramp up, think about that. If you're generating $4 billion, what's 33% of $4 billion? You're over $1 billion in free cash flow.
Yep.
And that's 1.2 billion.
And that's why I'm kind of aiming towards like an EPS of about $1 in 2026. If they can get the growth, right? Of course, it's going to be hard to get there. But if you think about it, I don't think it's too far-fetched to understand if you start increasing by 20 to 30% a year and you're already at a 2.2 billion after a couple of years of compounding at 30%, and your free cash flow margins at, let's just keep it at 1/3, 33%, then you're going to start churning out a lot of cash. And my real question is like, with all this cash, my real question is what is Palantir going to do? Are they going to continue to invest in new platforms? Are they going to create the venture arm that Chris Patel was talking about? I just don't understand, because their operating margin is so high, right? I just don't understand where they would park all that money. Like, it's just going to be such a cash flow machine, and it gets me concerned about, growth. What will they do? Will they just start buying back stock? Like, I just don't understand. In 6 years' time, 7 years' time, I think it's too early to start talking about dividends. I think it's too early to start talking about buybacks. But at what point do you start stacking so much capital that you have to start doing something like that?
Steve, real quick, do you have a mic with you? Can you just bring it closer, or you're not using a mic?
Is that better?
Yeah, that's way better. Can you sit closer or bring it closer?
Yeah, I'll sit closer.
Okay, that's actually way better. Go ahead.
Okay, so Matt, let's stick with what you said, and then I'll share my screen. I'm going to keep this slide up so I don't forget. So in regards to what do you do with all that cash? They have a ton of shares outstanding. So obviously buybacks is great for shareholders because it's the most tax efficient way to redeploy capital to shareholders. And not only does it increase the percentage of the company that our shares represent, it's going to increase EPS as long as EPS stays flat. As long as their earnings stay flat, their EPS will go up, because it's distributed across less shares. So if they buy back shares and they increase earnings from operation, EPS will explode on a percentage basis.
That's correct. That's correct.
So that is definitely good.
Here's some quick qualitative things from CodeStrap: training, certification, free tier, dev relations. I think that free tier, that could be a big thing to use that money into, to just get customers into the product and penetrating without having to create a burden of contracts or anything. So
yeah, I mean, he would know a lot more about that than me.
Yeah.
And I agree with everything he said, because it would make sense. But when you don't have debt, you can take chances and you can continue to build out other products. But don't forget, we don't know how big this is going to be. I mean, if Ives is right, he's not the only one that has said AI is going to be the fourth industrial revolution. We really don't know what that means. So I go back to, okay, let's think about from the 90s forward. Internet, gigantic companies were made out of the internet. Cloud, gigantic companies were made out of cloud. This is AI could be the next one of that scale. And some are predicting it's going to be bigger. And if Palantir is that far ahead of everybody, good luck catching them. Good luck. I mean, I think that's the biggest thing. And admit, I said this to you today also. I'm not going to say what company, but when you, as a company, and Matt can attest to this, go through a large-scale implementation on a software platform. After you're up and running on that, it is incredibly hard to get a company to switch. Because not only have they embedded all their data into it, not only have they retooled the organization to use that software, going through another implementation to leave that system, especially if it's in manufacturing or somewhere else. The uptake to do that, the consultants you need to hire, it's a massive undertaking. In some instances, you have to backfill positions. It is not something employees look forward to. It's not something companies look forward to engaging with. So once Palantir has you and they're showing you success, going somewhere else doesn't make much sense. Would you say that's an accurate statement, Matt?
No, yeah, it's well, yes and no. I mean, I see some parts of the organizations that I work in that are very quick to change, but sometimes it's in 5 to 10 year cycles. But for us at UDoc, we continue to develop on top of Foundry. We're doubling down every day, and I think we haven't really introduced AIP into UDoc yet. We've seen the demos, but I'm fairly confident they continue to do more and more demos within UDoc. I almost said my company, UDoc. But anyway, yeah, I can only speak for UDoc though, right? So I can't really speak for others.
Yeah, I mean, it's hard to speak for others, but normally when a company undergoes an implementation to a software and they're seeing success, it's going to take a tremendous amount to get them to go use something else, because it's not just learning a new platform, it's the implementation. Implementation's time and money, especially if you're bringing consultants in to help.
I think this is really important from the report when I was reading the report. And by the way, if anyone wants to, just DM me on Twitter, @AdamIsInvesting. I sent out a bunch of them today, so I'll send you the email. DM me with your email. The thing in the report that was interesting was, we'll talk about the valuation model later, but I wanted to know, what does Dan Ives think is the moat? And it's similar to what you're saying, Steve. Basically, he was like, look, the enterprise spend on AI is going to be ridiculous. He calls it a trillion TAM. And he says he thinks Palantir is one of the only companies. He compares some competitors, but basically says why they're not going to be able to do what Palantir is doing, to implement a large-scale AI platform for an enterprise that can actually keep the data secure. I mean, he says a lot of other words in there that we've all been talking about, but it's very similar to Bank of America's thesis, which is that this is one of the only companies in the world that can train your LLMs and build the tooling, the AI infrastructure, to make sure you can sleep well at night, knowing that all your stuff is secure. And it seems like, as simple as a thesis that is, it is a very difficult thing to execute at scale, even with what you're saying, right? With the experience you've had at work, trying to put all your data into one software. And if they can do that within a couple of months, maybe even a couple of weeks, then the argument Dan is saying about when he talks to CIOs, chief information officers, and the first call that they are making, this is what they're telling him, is Palantir, because there's no other reference point, was his exact verbiage. That is exactly confirming what Karp was saying a month ago, which is that we are getting a shit ton of calls in 12 months, in 1 month, because we're the reference point. We're the guys that people want to talk to.
So I don't know how applicable this is, but when you look at, and anybody can do a Google search and try to look at the cyber security insurance market, I can tell you firsthand, cybersecurity insurance policies have gone up hand over fist over the past 2 years. The amount of cyber crime out there is crazy. Indemnification, companies don't even want to indemnify other companies using their products. Not going to get too much further into that, but companies, especially IT teams, are taking cybersecurity extremely serious. And Google doesn't even have IL6, and they're the third largest cloud provider. Palantir has IL6 clearance. What do you think that means? The only other two are Amazon, Microsoft, the 1 and 2 cloud service players. So for number 3 not to have it in Palantir, you got to believe that your data is pretty safe with them. And there's much less of a concern utilizing them.
I want to take a step back because I think this is probably where people's heads might start running, right? So you've heard the word $1 trillion TAM for AI thrown around. Then you have the data analytics TAM. Let's just call it light, right? 300 billion. Maybe it's probably closer to the 900 billion in the next few years. Then you have the cybersecurity TAM. You have all these TAMs starting to compile on top of each other, right? But let's just say all the different things, simplify it, call it $1.5 trillion TAM. Let's say Palantir can get a 1% market share in that, which I think is light. Now you're talking about just in that particular thing alone, a $15 billion annual revenue kind of coming through to Palantir. Then take on exactly what Stephen was talking about with a 33% free cash flow margin. That's $5 billion a year, strictly on that. And then, Stephen, based off of, because it's a metric that you love. I prefer price to cash flow from operations because I'm an oil guy and that's kind of where I focus. But what would you put a good price to cash flow from a good price to free cash flow?
I'm glad you asked.
Yeah, because you're making a $5 billion. Let's just say in 10 years' time, $5 billion in free cash.
So I want everybody to understand something. These numbers were before Q1 earnings. I did these last week in my Palantir article, but I want people to understand that a lot of people think the market's going up, and a lot of people think we're going to hit new all-time highs at some point in not the too far distant, maybe the next year or two. I don't know what's going to happen, but it is not abnormal to trade at a 30-time price to free cash flow. You have companies in here that are not tech companies. Pepsi-Cola was trading at a 45-time free cash flow metric. Okay. Costco trading at 42 times free cash flow. These are not sexy tech companies. These are old school companies. I mean, Coca-Cola trades at 29 times. Now, keep in mind, these are from last week, so it's changed a little bit. But Microsoft was trading at 45 times. Meta was trading at 44 times. I mean, I don't even want to talk about NVIDIA or AMD or Tesla because really high. But you start talking about what is an actual real number that companies outside of tech trade for, it's not unheard of to trade at 30 to 40 times free cash flow. So on Matt's number, even if Palantir got a 30-time valuation, okay, if they're generating $2 billion in free cash flow, that's a $60 billion market cap right there.
That's reasonable. Yeah.
And if you're at 40 times where some of these traditional companies are, that's an $80 billion market cap. Yeah. And then you start getting into generating $3 billion, $4 billion, $5 billion in free cash flow. Well, $5 billion in free cash flow at a 30-time multiple is 150 billion market cap. And that's not even an overstretched multiple, considering that Microsoft trades at 45. I mean, I think it's fair that Palantir, with all the growth that they have, I don't think it's unreasonable for them to consistently trade at a 40 to 50 time free cash flow because of how much growth there is in the future. Hell, if AMD, who's already hit a growth spurt, can trade where they're trading and Nvidia trade where they're trading, and I'm not saying that the evaluations are correct, but that people are willing to pay those numbers for
Market's
them.
willing to pay it. Yeah.
So the market's ultimately the one that is correct, because in order to make a market, you need to have a buyer and a seller. People are buying. If more people are buying than selling, it goes up. So I want to see what Palantir does over the next couple of years, but I don't think it's crazy to think that they trade long term at a 40 to 50 time free cash flow.
And by the way, everything Matt just said, that the way he got those numbers was not even including NATO spending a crap ton of money, governmental agencies. That was just off one TAM within one sector in terms of old data analytics. There's other sectors for Palantir to
And
be.
let's not forget about upselling on new products and new features.
And a 1% market share, it's probably more likely to be a lot larger than 1%, right? So I think the 150 to $200 billion range, I think, is really where I see this in the next 5 to 10 years. Well, I shouldn't say 5 years, because that would kind of put it before 2030. By the 2030, 2032 timeframe, I'm really honestly thinking that it's going to be trading in the 150 to 200. I hope that they get me wrong, because this is, keeping in mind, the thing that bothers me the most is the way I view it is they're so far ahead in terms of how they organize data and how they get everything to go. What is next, right? What is their fifth platform? What is their sixth platform? What is their seventh platform? Or is there one, right? And that's where I'm kind of like, what else can you build on top of everything that they're kind of doing? Are they going to get into hardware? Are they going to get into cloud? I don't like, this is where like, I don't understand, and I think the thing that is interesting is the reason why they partner with AWS, Google, Microsoft in terms of the cloud is because they use so much cloud already. So it's like, at what point do they say, okay, enough is enough, let's apply our own cloud? Or is that even smart to do? Because the margins on cloud are less than what they're getting in terms of their operating margins anyway. So, you play this game of what's next after this, because really, I mean, I know it's going to take a few years to come out and play out, but it's like, at what point do you sit back and say, okay, well, this is working, right? We're profitable, 3/4 of profitability. The cash flow is going to start getting pretty insane. At what point, thinking about Tesla in 2019, 2020, when they start to move things into a realm of like, what's next? Are they doing energy, robots, batteries, like all these things? It's like, at what point do they have that sort of moment where they step back and say, hey, we're making so much cash, we have to become some sort of technology conglomerate?
Yeah.
Or do they buy a large ownership percentage in the companies that they partner with? I'm trying to understand. Like, I'm thinking, you guys know me, I'm 10 years down the road. I'm trying to understand at what point and how does the company pivot into making themselves the next Amazon or the next Google in terms of market cap? Because if they play it appropriately, I think that they honestly could do that. But I'm just trying to understand, like, where would I go if I was making this much capital?
So,
And
Matt,
I'm really struggling to figure it out.